Hello, everyone, and welcome to HJP Financial Group's market update for the first quarter. Hope everyone had a wonderful day. A little bit of a long one for me, but always a little exciting. This is probably the part of the business I enjoy the most, more or less analyzing what's going on in the market and really what does that mean for different types of investments around the world. Now, if any of you have any questions, you'll see on the bottom of your screen a little hand that says raise hand. So if you click on that button, I'll see it and feel free to ask me questions at any time, or at the end, I'll be happy to stay on the call for as long as you like if you have any longer, maybe personal questions you wanted to run through. All right, let's get started. So I always like to start with an overview of the stock market. And I always find it important to not so much focus on any 1 year, 6 months, 2-year periods of time. Always want to take in the longer reality. So what we're looking at right here is a snapshot of the last 25 years or so. So just a little bit of a history. So 90s were fantastic for US stocks. It was the biggest increase in the history of this country, which was mostly focused on technology names, computers, the first time the internet was around. So those things went crazy. And then you had the tech bubble where stocks got cut in half. We found a floor, rebounded, and then we had the financial crisis. So the characteristics of those two downturns was the tech bubble, which was mostly focused on growth stocks. Now there's two main types of stocks, growth and value. So think of a company like Uber that is fairly new, you think has a great upside potential. They're not really developed. They're really just focused on growth. They might not have a lot of good earnings. They're mostly focused on top line revenue, but they're having expenses as they're trying to get market share, trying to grow the business. It's a new concept. So individuals and investors might give them a little bit of a pass in terms of net income, as long as that top line growth is growing at a good pace. So in the tech bubble, if you literally put the word computer or internet in your name, your stock shot up because everyone just thought the upside was great. And so people just piled in, even when it got kind of ridiculous in terms of this company not really earning any money. So when that bubble had burst, created the tech bubble contraction of between 2000 and 2002. So that was, again, mostly focused on growth. Then we had the 2008 financial crisis. That was the other end of the spectrum. That's more your typical value names. That was a banking, real estate, more dividends focused, more brick and mortar economic problems was the deterioration that had the financial crisis of 08. Now, once markets bottomed in March of 09, we went on the longest rally in the history of this country, also the second largest by going up over 400% in a little over that 10-year period. That was interrupted by COVID. COVID had the fastest decline in history, 34% in about 5-6 weeks, followed by the government more or less providing a bailout to individuals, corporations, cities, states. Everyone got money. So markets kind of understood that, hey, if it goes up, we get to keep it. If it goes down, the government's going to print out a bigger check. So you had the fastest recovery in the history of this country. Now, always something that I find interesting, markets are famous for overshooting in good times and undershooting in bad times. So if we just literally drew a line from the bottom of 08 to today, you could almost draw a perfectly straight line. So really what happened in the last 3 years was kind of an outlier reality. We undershot crazy to the downside, understandably so. We shut off the economy dealing with COVID. And then once more or less bailouts came, we overshot like crazy to the upside and then came back to earth. So you have a lot of short booms and busts, but over time, there's not really too many other better places to put your money than the stock market. Over the last, I think it's 80 or 90 years, you averaged about 11% rate of return in stocks. There's not really any asset class, gold, real estate, bonds, nothing really competes with stocks in the long run. But of course, short term can be extremely painful. So we always want to have an understanding of, the money I might need in the next year or two, and the money that's my 5, 10, 15, 20 years. So at the end of the day, corporations tend to find a way for their earnings to grow, and the more earnings grow, the more stocks go up. But it's very important to break down the parts of what the stock market is. So the best way of doing that, or the best way of determining if a market is cheap or expensive, is the equation you're seeing here. This is what's called your multiple. This is how many times earnings am I willing to pay to own stocks. So it's the price divided by earnings gives you your multiple. Now for the stock market, you can look back. All right, let's look at 120 years of history. How many times earnings do we typically pay? Historically, a cheap time to buy stocks, if we look down here in the 2008 financial crisis, you could have bought stocks at 10 times earnings because there was so much pessimism out there. No one wanted to own stocks. Everyone thought the world's going to end, so you could buy stocks very cheap. 20 or 20 plus times earning, that's typically expensive. That's a sign that people think that the stocks are the only game in town. There's nothing better, and we don't see any other problems. The reason it got that high at the beginning of 2022 was if you looked at the alternative, bonds are paying you about 1-2%. That's with inflation of about 2.5%. So people are saying, well, why am I going to get out of the stock market when cash earns nothing and bonds are earning me 2% and inflation's 2%? You know what? I'll stay in stocks even though I think they're kind of expensive. So there's times that it can get too expensive. There's times it can get too cheap. Where we are right now is around 18 times earnings. Historically, average is about 16. So we're paying a slight premium to long-term averages. It's not uncommon. You can go 5, 10 years with paying a slight premium. Just because you're paying a slight premium doesn't mean it crashes tomorrow. So there's a lot of variables that go into mix. But, I was trying to give examples of kind of different ways of thinking about it. And I give the example of my office. So let's say you wanted to buy this office from me, and I'd say it rents for $10,000 a year, just to use a nice round number. And you check the other offices in the area and you say, well, it looks like everyone is willing to pay about 15 times rent to buy it. So that means about 150 grand. So, all right, let's consider that reasonable in normal times. Let's say we get a rumor that there's going to be a train station that's going to go into Fairfield directly to the city. Now it's going to be a hub. Now, just based on that rumor, my rent did not change at all. But just based on that rumor, now people are willing to buy it at 20 times earnings. Well, let's say the rumor goes away and all of a sudden there's a flood in Fairfield, which happens from time to time. Now no one wants to come here. Now I'll probably get about 10 times earnings. So I'm trying to give you some understanding of how the multiple works and its confidence about a certain area. So one thing for you to realize is stocks can move based on one of those things going up or down, the earnings or the multiple. So for example, you can have a reality that all the companies earn the exact same amount for 3 years in a row, and stocks could go down 30% because it's based in that situation, the multiple went down. People's confidence that this is not going to be shaken or go in a positive direction is gone, even though the companies earn the same amount of money. It's just the willingness, that multiple will fluctuate over time. That's why it's hard to predict exactly where stocks are going to be in the next 6 months, next year, next 2 years, because there's a part of the equation that's just based on how people feel and rumors, and sometimes things play out, sometimes they don't. So that's the part of the equation that makes it a little difficult to kind of predict where markets go, at least in the short run. Now, one thing to keep in mind, like I mentioned, we're pretty close to 18 times earnings right now. Now, in any 1 year, the next rate of return, the next forward-thinking 1 year rate of return could be all over the place. So when we look back at history, there's times where we're paying about 18 times earnings, that the rate of return over the next year was up 25%. And the same time, 1 year in the future, we were down 25%. So 1 year has a very wide range of probability of how things could play out. So this is 1 year returns. Now, if we look at 5 year returns, what we see is a more narrowing reality of how stocks perform. So 1 year, very hard to predict. The more we have a longer time horizon, those rate of returns tend to get into a very narrow range. So as we sit here today, the majority of times where we're trading at 18 times earnings, it looks like you had between 10 and 20% annualized returns. Now, there's also a bunch of times where it was relatively flat. But it's, all these outlier years of down 20, down 30, you don't see anything like that once you start going into more meaningful periods of time. Now, everyone on this call tonight, everyone thinks, I'm going to retire soon. I don't have a long time horizon. Oh, I'm not going to live that long. Everyone on this call tonight is a 10, 15, 20, 25-year time horizon. Everyone here should have a healthy amount of their money in stocks because stocks has done better than everything else. Now, we have to realize that there are market risks, of course, but for our longer term money, the market returns you get are worth the risk. Because don't get me wrong, I wish everyone on this call was worth 10, $20 million and I could just say, oh, put it in the bank, don't worry about anything. But we're all in a situation that we need, X rate of return above inflation to have this pool of money last us our entire retirement. That's the end goal. So stocks absolutely have to be part of the equation. And luckily for all of us, that's been typically a beautiful rate of return in the long run. Now, let's dive in a little bit on kind of the current reality when it comes to the economy. So last year was a relatively brutal year for the stock market, but the economy actually held up quite nicely. So going back to our equation, confidence in the market dropped a lot, but the earnings didn't really drop. So earnings were very good last year. Unemployment was very good last year. What really played out was inflation took off, which causes the Fed to act on that by raising interest rates. They raise them at an extremely fast pace. That typically brings you into a recession, but we were at such a healthy economy that it's just taken more or less longer to get there. So as of right now, there are predicting a earnings drop for this year compared to last year, but then kind of getting back to a normal upswing thereafter that. So most of Wall Street is predicting a shallow recession towards the tail end of this year. I also have that as my base case. So right now is probably one of the more pessimistic feelings that I have towards the market in the short run. Stop sharing my screen because it'll take a little bit of time. There's really 5 reasons to me that markets go up or down. 4 are associated with the earnings. 1 is the multiple. So we just went through the multiple scenario. Like I said, we're trading close to 18 times earnings heading into a recession. That's a tad bit high. So there's not really anything that I could see that would really push the confidence to get that to 19, 20, and 21. Especially with stocks having now an alternative to the stock market. If you can go get a CD that's paying 5% or bonds paying 5.5%, that's a pretty good option B if you think stocks are expensive. So on the equation of the multiple, I can't see that increasing. I just don't. Then we have the earnings side of the equation, which I would break down to 4 parts. You have the individual, you have corporations, you have fiscal policy, which is mostly the government, and then monetary policy, which is mostly the Federal Reserve. So I'm going to go through a few slides and kind of break down those 4 realities. This is just a quick detour on that. Always keep in the back of your head, we're in the middle of a pain point. Markets are down about 14% from their all-time highs. So markets went down 25 and we got about half that back. Now let's just say we just want to get back to even from all-time highs. Now it took 5 years in the Great Recession of 2008 to break even. So from this point, this is really 5 years plus already the 6 months we've hit rock bottom, which was October of last year. So this would be even longer. you would average a 5% rate of return. Not bad at all, not terrible. I use a 5% rate of return in our financial plan. So stocks give us 5 and bonds give us about 5. Beautiful. That's already the scenario I play out in the financial plan. Now, let's say what I said was true. We have a mild recession. All right, that typically takes between 2 and 4 years. You're getting a 6-7% rate of return for US stocks. Now, I actually think international and emerging is going to do substantially better than US, but hey, 6-7%, I'll take all day long. This is just a quick point why I don't think we've reached the bottom of this current downturn and why I think it's going to look a little bit more like a W. So like I mentioned, the peak of the market was last year, down 25% October. We've had a nice little rally to today. I will be taking some profits in the portfolio this week. I think we have one more leg down before we take off. What we're looking at here is the last 9 recessions. Now, the gray area is the actual recession. Now, recession is where the economy actually shrinks. The green line is what the stock market did. So as you could tell, 8 out of the last 9 times, really besides the tech bubble, the stock market bottomed somewhere in the middle of the recession. So if we don't go into a recession until the tail end of this year, it'd be very odd for the stock market to have bottomed in October of last year. So I think we probably have a little bit more of a bumpy road before we can kind of get back on a long-term bull market. Now, long-term bulls typically last 5-6 years, but I think we need to have a little bit more of a bottom form that we can kind of launch off at. Now, why I think this would just be a mild recession is for the 4 categories you see on this screen right here. 1 is housing, 2 is vehicle sales, 3 is business investments, and 4 is inventories. Now, what you could tell is pretty much everything here is at their average or below it. It's kind of hard to have a deep recession if everyone thinks a recession's coming and no one's doing crazy frivolous spending, and we're actually slightly at below average in these type of categories. This was the 2008 financial crisis. Housing got way out of hand, a bubble burst, and it crashed. Well, you can crash from up here, but if everything is here, it's like falling out of a window on the first floor. You're going to fall. It's going to hurt a little bit, but it's kind of hard to crash that far because we didn't go that high. So yes, I see more of a slowdown than a bubble bursting. So let me break down those 4 categories of earnings a little bit. 1 is the individual. Now, us as individuals got funds from the COVID stimulus checks. So our savings rate bumped up a huge amount. Last year, we had inflation and food costs and gas prices and rent costs all went through the roof. So what more or less happened was everyone got used to spending this high amount, and then we have all these expenses that ate into that. So all those savings are gone, and then people started spending on credit cards, which is normally the means of last resort. Now credit card balances are at all-time highs. So I don't see a situation where the consumer is going to surprise to the upside in terms of what they're going to be spending. And it really would probably make matters worse when the downturn did eventually come back, because debts besides the US government tend to have to be paid, or credit cards just stop letting you borrow money. So the fact that credit cards are at all-time high doesn't bode well for earning surprises due to the everyday consumer. 2 is corporations. Now, everyone probably heard the SVB Bank out of California and a couple other banks went bankrupt recently, and the government stepped in and protect depositors. But that sent shockwaves through the industry. So all the other major banks don't want to be the next one to fall. So what do? They clean up their balance sheets. That's a fancy way of saying we're going to stop lending so much to, let's say, subpar or even okay people who want to borrow, because we want to lower the risk in our pool of money. So what do? they tightened their lending standards. So lending standards shot up over the last year. So that means, let's say you want to buy a apartment building, you're going to fix it up and you're going to hopefully make a nice return on your investment. Unless you have pristine credit and a great track record, fewer and fewer people are going to be able to get that loan. That's going to slow down the economy. That means earnings come down a little bit. So much harder for kind of corporations to grow right now with the banks not willing to lend. So that's the individual, it's the corporation. Then you have fiscal and monetary policy. Fiscal policy is the government. So we have Congress that's divided. We have the Republicans in the House and the Democrats in the Senate. It's a fancy way of saying nothing is going to get through and we're going to have gridlock. So unless really the wheels are kind of falling off, you're not going to get too much compromising, especially as we approach an election, to kind of help stimulate the economy if need be. So I don't expect much out of Congress. And then the last one is your monetary policy, the Federal Reserve. Now, there's been a saying for the last kind of 15 years that the Fed put. So what that's mean is if stuff got bad, the Feds come in and bail us all out. It happened multiple times over the last 15 years. So, but the Fed has a kind of a dual mandate. You have employment and inflation is the two things they tend to focus on, or by perspectives or by law, that's what they have to do. So we have this inflation battle. In inflation, it was high as 9%. They're trying to get back down to 2%. We're now between 5 and 6%. So they have a ways to go. So the situation where if the wheels, maybe one wheels goes off, they almost have to ignore it because they have to fight inflation to get that down. So in the 4 ways earnings can surprise to the upside, I just don't see any of them really giving us too much of a reason in the short term. So this is why, like I mentioned before, I'm a little bit pessimistic about U.S. stocks in the short run. And this is why I think it's a decent time to take a little profits in my portfolios. Now, again, another reason why I don't see this as a bad recession coming down the pipeline is jobs. So right now we have close to all-time unemployment, 50-year lows. And the job market right now, the numbers just came out in the last day or two. So this is job posting. We have about 10 million jobs posted for about 6 million people looking for work. That was high as 12 million for the 6, so 2 to 1. It's never been like that in history. So even if we wake up 6 months from now, a year from now, and the 10 million job postings become 6 million, that's still a 1-to-1 ratio of people looking to work. That's still really good when you look back at history. So a situation where those jobs got hurt, those companies got hurt just to take those job opportunities off the table, that doesn't really hurt the economy that much. So again, see a slowdown, not a crash, in my opinion. So I was touching on inflation. Like I said, inflation touched 9% and is steadily gone in the direction we're all hoping for. Right now we're in the 5 to 6% range. And a lot of this is kind of year over year numbers. So everyone, just a little reminder, like last May was kind of peak of the hysteria and kind of the housing market, peak in the kind of the inflation world. Towards the tail end of summer, gas prices came back down to earth, food prices started to come back down, and then housing looks like it peaked in that May-June timeframe and then got a little stability towards the tail end of next year. So especially the year over year numbers coming up for April, May, and June will look pretty good. Will look like inflation is coming down meaningful. At that point, I think we find ourselves in a world of inflation in the 3 to 4% range, which is close to the 2 to 3% range that the government wants or the Feds want. But I do believe they'll be a little bit more patient and not do anything too drastic at that point. They're always watching the economy and inflation. So inflation at those levels, they'll tolerate it. So I think that the 3 to 4% reality, or even the 2 to 3% reality, is here to stay for a long time. Now, that is a seismic shift in the last 10 to 15 years. Now, so much so in my tip of the month that I try and do monthly, the video I sent out, it was focused on lazy money. Now, it wasn't a problem for the last decade if you had $100 grand in the bank earning nothing, because you would look at the wall of CD options and they'd say 1%, it's not worth it. It's no big deal because inflation was 1 to 2%. So it didn't really hurt you. But now if we're in a world where CDs are paying 5% and inflation is 5 to 6%, we cannot have lazy money. So going forward, you have to have a psychological change in that money needs to work. I'm not telling you to put, all right, I got to put in the stock market. I got to put in the, no. Money could be working in CDs. That's working. It's working hard. It's making 4 or 5%. I'll take that all day long. But we have to at least match inflation. That's the goal with your short-term money. So the money that I don't want to risk in the stock and bond market, so be it. But we have to find ways of capturing whatever inflation is. So most of the time, when you look back at history, CDs do just that. You can also do like short-term bonds if you want to be a little bit more liquid, but there are certainly low-risk ways to get yourself 2, 3, 4, 5%. Besides the money you need in the next 3, 4 months, everything over that needs to be working for us. So this is the Fed funds rate. And so we're going to touch on interest rates in the bond market. So, this is a little less than 25 years. So you tend to see a pattern here. Now, the pattern is the Feds raise rates because they're trying to cool off the economy. They typically do it in small incremental moves over, a 2 to 3 year period, just to make sure nothing kind of breaks. Then they raise it a little too much, causing the economy to contract, and then they bring rates back down. This was the 2008 financial crisis. This was 9/11 and the tech bubble. And then this was, the Feds getting off of their zero interest rate reality that they kept for a very long time to kind of stimulate things after the 2008 financial crisis, and then slowly started to raise them. Now, last year was very different. 0.75 moves would be an incredible outlier jump in what the Feds raised interest rate by. And we did it 3, 4 times in a row, let alone followed by a couple half a points in a row, followed by now we've got in 1 quarter. We'll probably do 1 more quarter and then that's kaput. So, and that was all condensed into about 10 months. So that is an incredible move. So when the Feds raise rates in that much, that quickly, that hurts bonds. So all the bonds at the time before the rates were moved were paying us 2, 3% for a corporate bond. Now, let's say you had a 10-year bond paying you 2.5%, and now at the end of the year, you can go buy one paying you 5.5%. No one would want to buy your 2.5%. So the price of that bond would be lowered because it doesn't pay as much as the ones available today. Now, that lowering caused the biggest decline in the history of the bond market. We finished the year down 13% in bonds. To give you some perspective, down 3 in 1994 was the worst year before that. So I have a bunch of nice older individuals who want to be conservative and say, Mike, what the heck happened? We went down double digits. Even conservative stuff last year went down double digits. Now, like many times in the history of investing, you have some pain and you want to not feel pain again, and so you want to pull out. Typically, like investing, it's normally the worst thing to do. So right now is arguably the best time to invest in bonds in 15 years. So as we look in 1994, when we lost 3%, the following year went up 19%. So what's playing out is when interest rates go up, that's the pain in bonds. So like I said, we're pretty much done with raising interest rates. So the pain's kind of behind you. Now, it's an okay time where now rates plateau and they go sideways. Beautiful. Then I'll collect 5.5% on my corporates. I'll take that all day long. So the price of a bond won't move because interest rates flatlined. They stayed the same. So I'll take that. As long as it offers me, I'll take that reality. Or let's say the Fed raises it too much and we go into recession. At that point, they normally lower interest rates. That's the great years for bonds. That means we collected our nice interest rates, plus all the bonds went up in value because you had a bond paying 5 and now bonds are paying 2.5%. So you get some appreciation on the bonds. So that's the reality as of right now. A positive thing going forward is you probably have the negative correlation with the stock market. the reason last year was so painful is normally when stocks are down, there's a flight to safety, which is normally the bond market, so bonds go up. So that's why they work invertly with each other. So that was broken last year, considering both went down double digits, but we probably have a more normal reality this year. Now, kind of the main tweaks I do in the portfolio, a few of the main ones, is moving between the types of bonds. Do we want to go higher quality or lower quality? Moving increase between stocks and bonds. And then on the stock side, increasing international to domestic. So in the international to domestic stock reality, we tend to go through cycles. So really, since the 2008 financial crisis, this is one of the best times to just be pure US. You didn't want to touch international, you didn't want to touch emerging markets. And then people get a little gung-ho towards the end. Why would it go anywhere else? That's stupid. US is the best, it's the best. Well, right now, US stocks are trading at 18 times earnings, and they pay a dividend of about 1.5%. International developed is trading at 13 times earnings and pays a dividend of over 3%. Emerging markets trading at 12 times earnings have a dividend of over 3%. So people rush into, for greed purposes, what did well yesterday. They get overpriced. And then at the worst possible time you're buying, you normally want to be on the stuff that's cheap. So, kind of the 2008 till now, US. 2008 to the tech bubble, you wanted to be international. And international did much better than us. 90s, great US. 80s, great international. So this is why we are always diversified. But on top of that, I'm certainly increasing my exposure to overseas just because it's much cheaper valuations right now. And in summary, always want to keep long-term in the back of our head. There's, in my opinion, two devils we always have to worry about: inflation and market downturns. So they're going to exist. There is no perfect investment. There are no, long-term 10% CDs. So we have to figure out, when do we want to deal with what devil? So your 1, 2, and 3 year reality. So what this slide's going over, stocks are in green, bonds in blue, and gray is a balanced approach. Now, everyone on this call is closer to the 50-50 balanced approach. So think of yourselves in that form. Over any 1 year, you can get smoked in all three. So, the money that you might need in the next year or two, we can't deal with the market devil, because it could really, really hurt us. You could, pick your head up 6 months later, be down 20%. So the money you might need in the next 1 or 2 years, we won't deal with stock and bond markets. We're going to be in cash, in conservative CD style things. So what's the devil we deal with there? We'll deal with the inflation devil. Because inflation minus the last year or two, normally let's call it 2%. Okay, I'll deal with the losing a little bit to inflation for the safety and liquidity of cash. So 1 year, 2 years, if you want 3 year money, cash, CDs, short-term bonds, very low risk stuff. So inflation, we'll deal with it. We're not willing to deal with markets. Now, in the long run, like I said, CDs typically average what inflation does. Let's say inflation does 3%, CDs do 3%. We need to earn a rate of return above inflation, because we're trying to plan for retirements that might be 2 or 3 decades. That's a very long time that we need to have your nest egg last us. So we need to get some extra return. Now, 5, 10, and 15, and 20 years, if we look at the gray, what do we see? Over every 5-year rolling period, going back for the last 75 years or so, you've never lost money in a balanced approach. So what does that tell you? Well, if I have a long time horizon, I'll deal with that market devil, because he's never sent me into a negative category in a longer period of time. And it's averaged 8.7% a year. If inflation's 3%, that means you averaged 5% above inflation. That's a well worth trade-off. So long-term, we can't have the inflation devil. We cannot have a situation, I use the fact that in the last 100 years, cash has lost 97% of its value. I saw that when I was going to buy a house, like you'll see, the history of the house you're looking at, and someone bought it in 1986 for 84,000, and now they're asking 840,000. So, cash and CDs, short term, great. Long term, we're doomed if we don't find something that's going to provide a rate of return above inflation. Now, I don't mind diversification. I like, rental real estate. Absolutely. Diversify all your different types of income. If that's, something that speaks to you, great. But, it's really real estate and the stock market are the two main things besides owning your own small business that gives you a rate of return above inflation. Neither of them are perfect. Stocks are very volatile. Real estate, it's not going to be as volatile because you're not buying and selling it every other week. But one day the furnace goes. One day you have a tenant that doesn't get out for 6 months and you got to take them to court. Both of them provide about the same rate of return in the long run, but has their own set of problems. So there is no perfect reality, but you can't kid yourself. Always ask yourself, well, how am I doing against inflation and how am I doing against market volatility? And so it's much more about segmenting your money into an appropriate bucket than it is about saying this good or that bad. Well, I hope everyone found that useful. Like I mentioned, the takeaways is inside the portfolios now, I'm doing a little bit more overseas. I'm taking a little risk off the table. And within the bond side of the equation, I want to be a little bit more higher quality. It's not worth to go low quality, considering even the conservative stuff is paying 5%. That kind of gives you a good overview of the markets, and then a good overview of what I think investment-wise makes the most sense right now. If anyone has any questions, feel free to raise their hands. Okay, perfect. Well, of course, I am always here. Shoot me an email, give me a call. I'm happy to discuss anything that you like. I hope everyone has a wonderful evening, and I'm sure I'll talk to you all soon. Have a good night, guys.